Welcome to our next video. In today's episode, what we're going to do is we're going to take a look at what sucks about trading covered calls. Yes, there are a lot of great benefits, but there's also some things that really suck about trading covered calls. I'm going to cover some of those things in this video. Before we get started, you can also learn more about covered calls in our covered calls class or course, and you can do that by going to our website, tradersfly.com. There's also a ton of freebies, and if you want to get one-on-one help with covered calls or even just coaching in general, just check out the website there at tradersfly.com. All right, let's get started here. I want to show you some insight on what sucks about trading covered calls. So we're going to go ahead and talk about some of these things. There's a couple of issues. Number one, it's a little more complex. There's some lost opportunity, and you got to kind of wait sometimes for some of those things to pan out. So we'll get started here. And let's just talk about the basics behind this strategy. So as you buy a stock, let's say here's our stock, and the price continues to head kind of higher. You buy it here, okay? Down here would be your loss, or losses. Here would be kind of your profit, okay? So if you paid 170, as you continue to go up, price of the stock goes up, your profit continues to head higher. So we can continue to, make more profit as the price of the stock heads higher. Now, what we're doing with a covered call is we're saying, hey, I'm willing to sell that stock now at maybe at a higher price, like let's say 210, 220. So what it does is it caps me right here. But for waiting, okay, so one call that I sell, but because of this, it caps me. Now I might receive, let's say $300 for doing that for each contract. This would be 100 shares here. But for waiting, I make, maybe about $300. Could be $50, could be $20, could be $500. It just depends on the value of that contract, okay? But here's the issue, okay? If this continues to head higher, let's say to 250, you lose out on this profitability. So there's a lot of profitability that you don't make. Now, granted, you make some premium. So even if it goes a little bit higher, you're okay because you make the premium for it. But if the stock just jumps from 170 to, let's say, 500, you don't get to make that. Now, most of the time I'll say, hey, stocks don't explode. They don't go to the moon, but they kind of do something in between those ranges. So many of those instances, you'll be okay. If it moves sideways, you're good because you'll make the premium. Goes up slowly, you make the premium still, and you appreciate from the stock. Goes up a little faster. Again, the big issue is when it really explodes, and if it pulls back, you get to make it a premium at least, not just nothing. So it kind of helps that situation. So when we start looking at this, there is some lost opportunity, which is kind of the big thing people go against, but I think that's still not too bad because most of those cases you're still okay. The other problem is sometimes they're a little more complicated because now you're not just buying shares, you're also selling one of these against it. So you're selling a call. And when you're selling this call, it makes it a little bit more complicated. So as we take a look at this right here, what's happening is, it becomes a little more complicated. So as we go in and let's say we're doing an example here on GRPN, Groupon, okay, and let's say I buy a bunch of shares right here. Well, this is pretty easy. I could go ahead and say, okay, I've got 10,000 shares. Okay, so now as that stock heads higher, boom, I make some decent money, right? But the issue becomes now, okay, well, now as I deal with a second thing, okay, similar to what I just showed you, now I have to deal with two things. Well, I could sell the call against it. So just go in and sell this one. And then I can start selling the number of call contracts here, right? So as I start selling, because I have to go in and sell many more, and you can easily just type it in. So let's just type it in. Now I've got a covered call strategy, but it's more complicated. I'm dealing 10,000 shares here, 100 contracts there. And now I've got kind of the strategy, but the problem with it is it's more complicated. Now you have to manage two things. For some people, this is too much and it starts to become a little bit of a problem. The other thing is let's say the stock does continue to move up very quickly. Well, now I might be stuck in that position for another 30 days or 40 days. Now you could get out of it, but now you have to buy back those calls at a higher dollar value, taking a loss on the calls. And if you want to keep the stock, or you could just buy more stock if you have the capital. But that's kind of the other part where you get a little bit of the issue is that lost opportunity, or you got to wait because now you're stuck for those 40 days, 50 days, 80 days, 20 days, whatever the duration you sell is. So anyway, those are some of the problems going on with selling covered calls and some of the things that sucks about it. I think there are many more advantages than there are disadvantages. So I think there's nothing you should be worried about from selling covered calls. It's more along the lines of, well, if the stock keeps pulling back, that's where some of the problems lie. But if it pulls back, at least you're getting some premium for it, right? Like in this case, if I got 10,000 shares of Groupon, well, I'm making $4,000 for those covered calls in about 40 days. But granted, 10,000 shares of Groupon also costs you quite a penny, right? So current stock price is 1075. 1075 times 10,000. Okay, it's going to cost you $107,000 just to get that stock at that level. Now, could you go ahead and just sell 1,000 shares or buy 1,000 shares? Sure. And then you sell kind of 10 contracts against it. Yeah, you could do that too. It's about a lot cheaper. So now that'll cost you only $10,000 on that instead of much more. So 10,700, right? And now you could sell covered calls against it, and you could make about $400, every month or so on it. And there's a lot of great benefits there, as you can see. But anyway, I just wanted to share that with you, that there are some downsides to this. And a lot of those things really is, well, sometimes you got to wait. Sometimes you lose the opportunity because it could keep going higher. And other times it's just more complex. And if you look at really the lost opportunity, this is what people worry about, is if they get a cheap stock like this, and it goes past 13, because right here I've got the covered calls saying I am willing to sell it at 13. Okay, current stock price is at 1076. Well, if it goes to like 24, I don't make any more money between 13 and 24, or even if it gets to 50. So that's a bit of the downside, but most stocks, they are not going to explode to the moon. So anyway, hope that helps. Thanks for joining me. Don't forget to check out the tradersfly.com website. Hope you have an awesome, great day ahead, and I will see you in the next video, maybe course, maybe one-on-one session. Feel free to reach out, give a call, and I will see you next time.